Hey guys, welcome back to another one. This time we have three more growth stocks to look at, all within the tech space, but certainly very different in terms of their businesses. But these three companies are being picked by some top analysts at the moment in terms of their future potential, all with some pretty good price targets in terms of upside potential. So let's have a look at the three stocks and let's dive right in and see what we're getting. So the first company we're looking at here is TWOU Incorporated, ticker TWOU. This one is a digital education firm. Obviously, with what's going on right now, this type of business is making headlines and will be under quite a lot of buying pressure. So as you can see, the results came out around here at the start of August, and it has fallen off because of those. The results are kind of not amazing, but in terms of the revenue growth, that's what people are looking at. So as we move through to TWOU, obviously, as you can see here, they have 135 plus degree programs and they work with over 75 universities. They currently have about 170 courses. And in terms of their partners, well, they have a really good list of partners. I mean, it's pretty much every big university that you can think out there, even Harvard that they work with. So obviously each one of these businesses, they're going to work with to a different degree. But in terms of the businesses they're working with, there are a lot of them and they are pretty highbrow. So overall, I would say that is a positive for TWOU in terms of their clients. And obviously they can go through directly to the consumer as well. Now, in terms of their Q2 results, it wasn't the best in terms of profitability, but revenue is growing. So as you can see here, 35% revenue increase. That is a good thing. And actually the alternative credential segment, as you can see here, that increased almost 100%. So what I can see TWOU doing is really moving to different areas, and we'll see that in their results as well. They are really spending a lot on new courses and moving into different areas that maybe can increase the top line overall. Having said that though, their adjusted loss was 34 cents a share, which is actually better than the 43 cents a share that they lost last time around. So it's not terrible in terms of the actual results. And as you can see here, actually they did acquire another company called Trilogy. So 50 million increase was driven by the $33 million incremental operating costs related to Trilogy, which was an acquisition for them. And as we move to the results, as you can see here, the revenue, it has grown pretty well. So that's about 50 million top line growth. So 182 million in terms of revenue. And it is a good growth over last year. And as you can see, they have spent a ton of money on curriculum and teaching, also servicing and support. That has taken some real big jumps up. So along with the revenue increases, they are spending quite a lot on, as you can see, the technology, marketing and sales gone up a lot. So to get that extra revenue, they have had to spend a lot. But from what I can see with TWOU, they are sort of moving into some different courses, and I guess setting this up is going to be expensive to begin with. You can also see here definitely that they are making quite a big loss here on debt extinguishment. So basically writing off bad debt that just didn't happen in 2019. As you can see here, accounts receivable, it has basically more than doubled from last year. So again, that could be a positive, and if they get all of it, but if they don't get all of it, then it could be seen as a negative. In terms of the price of TWOU, as you can see, it's been a good trend over 6 months, year to date. It's been a really good trend, and they had a lot of volume down here when the price was selling off. But as you can see, they've really maybe hit a level down at this price around the $38 price, and you would see that as some kind of support. If it did bounce off of that level, then it might be going back up to the 45 level if there is some buying interest. In terms of tipranks.com, just putting together a lot of different analysts. As you can see, 6 buys, 2 holds, and there are no sales here. The price consensus is about $49. So about a $10 upside to the current price. And really for TWOU, it's a growth company, and okay, you expect some quarters where they are just going to be investing in growth, acquiring, and really not making much money, which is exactly what this one was about. But really the story for any company like this is, online education, which is definitely a growth play. So we'll see if that works out over time. Needham do like this stock, so they have a $40 price target, so a little bit above the $38 that it's currently trading at. Needham say that they do remain bullish on TWOU's growth prospects, and the company continues to find creative ways to drive accelerated adoption of online education. It definitely is one of the leaders in the space in terms of that, so I guess we'll see how TWOU does in the future. All right, and next on the list, we have this stock, Analog Devices, and this certainly is not like TWOU. This is not a small growth company, but it is in a growth area. And as you can see by the yield, it's actually quite a good yield for tech companies. Tech companies maybe pay 1% usually, or obviously every company is different, but $42 billion market cap. And Analog Devices is really a semiconductor producer. And this one actually at Oppenheimer has been rated as a buy. They like this stock and they have a price target of 140, which is about a 20% upside. As you can see, currently trading around 116. It's actually down for the last 6 months. Year to date also down, and for the last 12 months, just higher. You can see it took a massive dip in the market dip, the general market dip, but it has recovered quite well after that. And obviously the big player, the competition to Analog Devices, is Texas Instruments. We'll look at the comparative share price moves of those two companies in a second. But in terms of the price to earnings ratio, 40, it is on the higher side. It's certainly not massive. I've seen way more than this, but 38 price to earnings ratio for a company that you would expect to grow isn't terrible. They do have a fairly decent dividend as well. But in terms of the share price over the last year, as you can see, pretty boring stock. There isn't some amazing growth here, but certainly Oppenheimer do think it is a good company. Now, the reason why Oppenheimer like this actually is because of an acquisition that they are making. So they are in the process of acquiring Maxim Integrated, and that is an all-stock transaction worth about $19 billion. Now, ADI, which is Analog Devices, apparently could see up to $275 million in cost efficiencies because of this acquisition. Oppenheimer said they do like this acquisition, and they see this as a key to the rival of Texas Instruments. The analyst there said, "We believe ADI has one of the most attractive core business models in analog semiconductors, and they remain long-term buyers." So as we really dive into their latest results, you'll see that this business actually isn't doing too much. So as you can see, the revenue down a little bit, 2%, gross margin down 3%. ADI have said that market conditions were pretty challenging, and I get that for a lot of businesses it is, although the next company we've got on the list has done pretty well during this time anyway. But as you can see, the business isn't really doing much, and that's why the share price hasn't done much. But obviously, this acquisition of Maxim Integrated is going to really put a rocket under the growth of this company. You're going to have cost savings overall. So as you can see, the revenue, it's not really done much. Cost of sales hasn't done much. This business really is no change from the year before, which is why the share price hasn't really changed either. What they have done though is really set the financials up just to make a slightly higher net income than they did last time around. As you can see, they just beat out last time. And how have they done that? Well, they haven't spent as much on research and development, and they haven't spent as much on marketing either to get around about the same revenue. We are really in a very narrow trading range over the last month or so. This is year to date. So again, there's not really much trend here that would say that this is really going to go. But in terms of Oppenheimer, they see this one as a long-term play that can take advantage of 5G going forward and this acquisition as well. Analog versus Texas Instruments, they were trading very close to each other a few months ago, but certainly Texas Instruments has pulled ahead. Analog Devices just consolidating and the share price not doing much, but Texas Instruments share price certainly appreciating much higher, and you can see the delta there is increasing between them. Okay, and then we move on to number 3, and this is Nvidia, who just came out with their Q2 results, which were absolutely blockbuster for a huge company. Now, Bank of America have reiterated this as their top pick. And this is following those amazing results, which we'll get into. But as you can see, $313 billion market cap on this. Now, Bank of America have a $600 price target on this stock. As you can see, right now trading at $500. And yep, this is all-time highs for this stock. it's just had a huge run up this year. And as an investor, that share price chart, obviously, if you're not in this one, buying up here, obviously always difficult if you're trying to get into a stock, but it's had a brilliant run for a reason. Not just the fact that people are investing in tech right now and the good tech companies are being valued very high. This thing, even as a big company, $300 billion market cap, had amazing earnings. As you can see, the dividend yield, pretty small right now. That's obviously because of the share price rise as well. Are they going to be upping the dividend, maybe paying a bigger dividend? They're certainly earning enough cash for that. So as you can see, trading at about 93 price to earnings ratio right now, but their revenue growth, their earnings per share growth is massive. So in the Q2 results, they actually had a year-over-year sales increase of 30%, earnings per share increase year-over-year of 50%. And this is organic growth as well. It's absolutely amazing. And in terms of margins of the business, they're making about 38% margins, which is absolutely industry leading. Nvidia are, by every single metric, a massively profitable and solid company. Now, Nvidia, if you don't know, they really have two main businesses, although they do get into other businesses as well. But the first one is gaming chips. So chips for gaming PCs, very powerful graphics processors. The second business that they've got into recently and is a huge growth business for them and is also extremely profitable is the cloud and data center business. This is really going blockbuster, AI as well. It's all part of the chips that they're using. So cloud graphics processing, AI processing, and it is an incredibly profitable business for them. How profitable? Well, look at this revenue growth. Remember, this company is a $300 billion market cap company. It is not a small company, but the revenue growth is just incredible. So as you can see, last year, 2.5 billion in revenue, here 3.8 billion in revenue year over year. That's just a massive increase. Now, cost of revenue has gone up, but as you can see, gross profit, absolutely incredible amount of gross profit. Year over year, this is amazing growth from a big company already, and it just shows that they are in the right areas. In terms of their net income per share, as you can see here, $1 per share. Now, that's in this last quarter in Q2, which is actually more, almost double the yearly dividend that they pay. So that's why I was saying, could they just be paying maybe a higher dividend? Maybe they're going to put that back into research and development. You can see about 200 million increase in R&D, but they could obviously spend way more on that. They did actually up the sales costs, so sale and general admin costs have gone up a lot here. As you can see, gross profit is incredible, and earnings per share, net income, as you can see, taken a big step up as well. This is just a cash generator right now. Now, as we move on to the long-term debt, this is something I want to highlight. As you can see, it's gone up from about 2 billion here to 7 billion here. So obviously that could be a bad thing, but obviously this long-term debt is to acquire Mellanox. They made an acquisition of Mellanox, which apparently should add to the top line revenue about 14%. They did pay about 7 billion for that company, and obviously they took out long-term debt to finance that acquisition, which at this current time is no issue because interest rates are incredibly low. Now, this company is just trading at all-time highs. There's no way around it. It's a strong company, as you can see. It's apart from this hiccup here down in March 2020, really it's just been all strength from there on, and that's because they have incredible growth for a big business. And what I like to see here in terms of the share price is we're having a nice share price rise here, but it is also on big volume, and that shows there are just many buyers of this stock. So this is a strong rise, big volume and share price rises in this stock. So there are some big buyers in this stock, and it really is just a straight line up in terms of the share price appreciation over the last 6 months. Bank of America are valuing this at 600. That's their latest price target. That is a high in terms of other analysts, but currently trading at 507. Now, if we look at Nvidia versus Intel, Intel have had a really tough time of it in terms of their future products. They really are behind the situation in terms of the competition. The processes that they're using, they're just not up to the times. And as you can see, the two charts just have completely diverged. Nvidia just outperforming Intel, and According to some analysts, Nvidia may possibly be the first $500 billion market cap chip producer, and I think, well, personally, it will go there as well. In terms of tipranks.com, as you can see, putting all these analysts together, they do have a price target of 525, which is still above this. Obviously, this changes as they get more information. Still a very strong stock overall, though, and a very positive story for Nvidia in general. Three different businesses for sure. Out of the three, Nvidia just looks so strong in terms of top line, bottom line growth, the areas that they're in. It's just so profitable and growing as well. So Nvidia, even though it's a huge company, there's still massive growth there, and it's trading up at all-time highs for a very good reason. A really solid company overall. I hope it was helpful. If it was, please give the video a thumbs up, and I'll see you in the next one.